Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today we're diving into Quanta Services, Inc., PWR. You've probably seen their trucks, that orange lightning bolt logo. I mean, it seems to be everywhere infrastructure dollars are flowing, from modernizing the grid to building out the new backbone of AI data centers.
And that really gets to the heart of it. Quanta is positioned as the indispensable total solutions provider for the generational grid modernization cycle. It's betting its record $39.2 billion backlog and its plus 80% self-perform Moat will accelerate double-digit EPS growth and capture these huge high-voltage transmission opportunities, despite, and this is the key, despite an acute skilled labor scarcity and the risk of macroeconomic CapEx cuts.
That thesis, I mean, it really sets a high bar. You're laying out this phenomenal growth potential on one side,
Right.
a company just riding the crest of these massive structural weights, but on the other, you're immediately flagging these huge execution risks, labor shortages, macro headwinds. So for you, the investor, the question isn't really if the demand exists. That seems obvious. The question is whether Quanta can actually execute on that massive $39.2 billion promise and do it profitably.
That is the entire ballgame. Execution is everything.
Okay, so let's start by defining that momentum. Let's look at the financials they just posted, specifically for Q3 2025. Because this wasn't just a quarter of, maintaining the status quo. It really signaled an acceleration.
It did. The momentum in Q3 was, well, it was robust.
Yeah.
And it reflects the increasing scale and I think the higher complexity of the projects they're now taking on. When you just look at the raw performance snapshot, the figures are extremely compelling. Consolidated revenues hit $7.631 billion for the quarter.
And just for context, how does that compare to last year?
That's a powerful 17.5% increase from the $6.493 billion they pulled in during Q3 of 2024. A huge jump.
Wow.
And that top-line momentum, you see it translate almost immediately to better bottom-line efficiency. Their consolidated operating income rose 20%, reaching $517.2 million.
So operating income grew even faster than revenue.
Faster than revenue.
That suggests, to me at least, that management is successfully navigating inflation and project costs. They're actually delivering some slight margin expansion on a much, much larger revenue base.
That's a great point. And for investors who are, really focused on shareholder value, the adjusted diluted earnings per share, the EPS, it clocked in at an impressive $3.93 for Q3.
So this kind of double-digit growth year over year, it's not some far-off projection. It's happening right now.
It's happening now. These market tailwinds we always talk about, electrification, data centers, grid hardening, they are converting directly into tangible earnings today.
Right. And while those GAAP numbers tell one story, I always find the adjusted non-GAAP metrics, especially EBITDA, give you a clearer picture.
Yes, it offers a vital gauge of the company's core operational cash generation. It strips away a lot of the, let's call it noise, that's just inherent in a company that's growing this fast and is so acquisitive.
So what was that number?
Their adjusted EBITDA for Q3 2025 came in at a massive $858.3 million.
$858 million. And that's up from what, the year before?
Significantly up. It was $682.8 million in Q3 of 2024.
I want to pause on that adjusted EBITDA figure for a second because it can cause some confusion, for listeners who aren't deep in M&A accounting.
Sure.
To really see the core performance, we need to understand what Quanta is adjusting out to get to that $858 million. The sources list a few key things. Can you walk us through those?
I can. So the primary adjustments are items that are either, non-cash or they're directly tied to their very aggressive growth by acquisition strategy.
Right.
For Q3, they excluded $46.9 million in non-cash stock-based compensation. That's pretty standard for a public company incentivizing its people with equity.
Right, that's normal.
More importantly, I think, they excluded $31.9 million in acquisition and integration costs.
And that figure is always there for them, isn't it?
It's persistent.
Yeah.
It is, because Quanta doesn't just grow organically. They are constantly buying smaller, specialized firms and then vertically integrating them into this total solutions platform we're talking about.
So those are legal fees, accounting.
Legal accounting, all the integration complexities. And then finally, they excluded about $6.8 million related to a change in fair value of contingent consideration liabilities.
Which is basically...
It's money related to acquisitions that have already closed, Often it's related to earn-out structures, where the final price depends on the acquired company hitting future performance goals.
Oh, I see.
So when you strip out these non-cash and sort of non-recurring integration costs, you get a very strong, very clean picture of the cash being generated from the business's massive operational base.
So the message is clear. Even while they're spending money to absorb new companies, the core infrastructure business is just a cash-generating machine.
Exactly.
And that financial strength, it obviously translated directly into management's confidence for the full year. They
Yeah.
didn't just meet expectations, they actually raised their targets.
They did, which is a really strong statement of conviction. It signals that they see this momentum continuing right through the fourth quarter.
What are the new targets?
They set the midpoint for their target adjusted diluted EPS at $10.83. That's within a range of $10.58 to $11.03.
So hitting that target, that would confirm the aggressive double-digit growth story.
It absolutely would. But I think the real structural strength is reflected in their cash generation targets. They set the target free cash flow midpoint at a really robust $1.7 billion.
$1.7 billion in free cash flow, with a range I see from 1.3 up to 2.25 billion.
Right, a wide range, but that midpoint is the key.
Generating 1.7 billion in free cash, especially in an industry like specialty construction that's so capital intensive, that really changes their optionality, doesn't it?
It radically changes it.
How much of that free cash flow is, just locked up in required maintenance CapEx versus being truly available for more M&A or, say, returning capital to shareholders?
That is the pivotal question. And in their industry, yes, capital expenditure is high. But because of their massive scale and the recurring nature of a lot of the business, especially the utility work, Quanta can often manage its CapEx very efficiently.
So the 1.7 billion is real.
It demonstrates they are generating cash significantly above what's needed for just simple maintenance. This liquidity, it provides the engine for their future strategic moves.
Like the DSI acquisition.
Exactly. Absorbing large, cash-intensive acquisitions like DSI, which we'll get into, and continuing to invest heavily in their fleet and specialized equipment, it signals a very healthy financial position.
And it's not just them saying it.
No, you have external validation. Look at Moody's, which revised its investment-grade rating outlook to positive back in July of 2025.
And a positive outlook from a rating agency basically means they see this momentum as sustainable.
Sustainable, and that there's prudent financial management underpinning these, frankly, phenomenal results.
So the financial foundation is rock solid. They're leveraging this incredible current demand into massive cash generation and a really favorable capital position.
That's it in a nutshell.
Okay, let's unpack this next point then. Because if Q3 was the proof of current performance, the backlog is the proof of future visibility. And this backlog isn't just another metric on a spreadsheet.
No.
It's arguably the most powerful structural asset they have, the thing supporting the whole long-term investment thesis.
Absolutely. The record backlog serves as their primary moat against any short-term market volatility. It provides, frankly, unprecedented revenue certainty for years to come.
And what's the total number now?
As of September 30, 2025, the total backlog stood at a staggering $39.174 billion.
$39.2 billion.
Which is a huge sustained increase. That's up 13.4% just since the end of last year.
$39 billion is just.
Right.
It's an astronomical figure. It has to dwarf most of their competitors. For our listeners, can you break that number down? What do the segments tell us about where the big infrastructure money is going in the U.S. right now?
The split tells the story very clearly. The majority of that revenue visibility, it rests squarely in the electric infrastructure segment. That accounts for $22.310 billion.
$22 billion just in electric.
Just in electric. And that includes everything from high voltage transmission, distribution, grid hardening, all the way to integrating renewable energy sources.
And the rest.
The remaining, and it's an equally impressive portion, is in the underground utility and infrastructure segment. That holds another $16.864 billion.
So the sheer size of that electric segment backlog, which you said is mostly utility-driven,
Right.
it really highlights that the spending is non-discretionary. This isn't stuff utilities are doing because they feel like it. This is work that has to be done for grid modernization and reliability.
It has to be done. It's a foundational need.
Okay, while that 39 billion figure is incredibly compelling, investors, you always have to consider the risk. How much of that huge future revenue is hedged against, say, materials inflation or labor cost escalation or project delays? Is this backlog a fixed-price time bomb waiting to go off, or are the contracts structured to be defensive?
That is the most critical question when you analyze any large construction backlog. And Quanta mitigates this risk in a few key ways.
Okay.
So yes, a significant portion of their large, complex work is on fixed-price contracts. There's about 56% of the revenue in 2024.
Which is a big number.
It is. But they are extremely selective and very detailed in how they scope those projects up front. More importantly, though, a huge component of the stability comes from their master service agreements, or MSAs. They provide a real buffer.
And how much of the backlog is made up of those MSAs?
MSAs account for a crucial 38% of the estimated 12-month backlog and 43% of the total backlog.
And these are different from the big fixed-price jobs.
Very different. These contracts are typically shorter duration, recurring utility work, things like maintenance and small upgrades. And the pricing is frequently renegotiated, or it contains mechanisms to pass through material and labor cost escalations.
Ah, so that's the inflation protection.
Exactly. This recurring MSA business provides both stability and a degree of inflation protection that offsets the higher risk exposure of those large multi-year fixed-price projects.
That makes the distinction really vital. The big projects offer the highest potential margin, but also the highest execution risk. While the MSAs offer a lower margin, but it's predictable, resilient revenue with that cost protection built in.
You've got it. And beyond just the stability, this backlog also offers exceptional short-term visibility. It's not just some blue sky dream about projects 5 years from now.
So how do we see that?
We look at what's called remaining performance obligations, or RPOs. It's a way to forecast near-term revenue, and it gives us certainty about their execution speed. As of Q3, their RPOs were about $20.97 billion.
So about half the total backlog.
Yes, and here's the critical data point. 64.1% of those remaining obligations are expected to convert to revenue within the subsequent 12 months.
64% in 1 year.
In 1 year. That means Quanta has immense certainty about its throughput and cash generation over the next year. That is a rare, rare luxury in the construction sector. It tells you these projects are largely shovel-ready or already underway.
And looking forward, the massive growth isn't just about maintaining the current grid. It's really about capturing this immense opportunity in high-voltage transmission. The kind of infrastructure you need to move massive amounts of renewable energy or to power these new industrial load centers.
That's the generational tailwind. That's what separates Quanta from smaller competitors. The U.S. has this huge installed base of transmission infrastructure, the big high-voltage lines that are now 50 to 80 years old. They're all nearing the end of their useful lives.
And the replacement cycle is a huge market.
It's estimated to be over $10 billion in annual investment just for replacement. And Quanta is actively positioning itself to capture opportunities from these planned 765 kV transmission grid upgrades through 2030.
We should probably clarify that jargon for the listener. What makes a 765 kV line so special and so difficult compared to, say, a standard 138 kV line that you might see more commonly? Why is this specific voltage class such a major long-term driver?
It's a great question. Think of 765 kV as the interstate highway system of the electrical grid. It's ultra-high voltage. It's designed for bulk power transfer over very, very long distances, often carrying power from remote renewable generation sites, like a giant wind farm or new industrial centers to large population areas.
So it's a much bigger, more complex beast to build.
Exponentially more complex than local distribution work. You're talking about massive towers, specialized materials, huge land footprints that often involve complex eminent domain issues and highly specific regulatory approvals.
And the stakes are higher.
The consequences of failure are catastrophic. A failure on a 765 kV line can destabilize an entire regional grid. So because of that, there are very, very few contractors globally with the expertise, the equipment, and the insurance capacity to even handle them. Quanta is one of those few.
And the sources noted something interesting about these projects in the backlog.
Yes, and this is key. The importance of this segment is highlighted by the fact that the material transmission projects, particularly 765 kV, are noted as being all mainly to come.
Meaning they're not even really in that $39 billion number yet.
Exactly. They are not yet meaningfully reflected in the current total backlog. This implies that future backlog growth is already baked into the cake, independent of all the projects we're already talking about.
That distinction is so important. So the $39.2 billion backlog is today's reality. That's secured revenue. But the future is potentially even larger and more profitable once those massive 765 kV projects start converting from the planning stage into firm orders and execution.
That's the long-term story.
This immense backlog, though, it implies Quanta needs to execute at a pace and a scale they haven't before, especially on these complex, tight schedule projects coming from data centers and all this manufacturing reshoring.
Right, the pressure is on.
And that speed, I have to imagine, is exactly why they went out and bought dynamic systems. This feels like a pivot from just being a contractor to being a full-service solutions architect.
That's the perfect transition.
Yeah.
It brings us directly to the strategic necessity of the Dynamic Systems, or DSI, acquisition. That was completed on July 25th, 2025.
A strategic necessity, so they had to do it.
I believe so. Quanta recognized that to really capitalize on this boom in data centers, semiconductor fabs, and manufacturing reshoring, they needed to vertically integrate. They couldn't just do the external grid work and the internal electrical. They were hitting a ceiling by not controlling the mechanical and plumbing systems. That's the other half of the critical path.
And dynamic systems provided that exact missing piece. What were the specifics of that deal?
The acquisition cost was approximately $1.26 billion, paid in a mix of cash and stock. And DSI's expertise is highly specialized. They provide turnkey mechanical, plumbing, and process infrastructure solutions.
Turnkey meaning they handle everything.
Everything from design to installation. Their primary target markets are these high-growth load centers, tech, semis, healthcare campuses, advanced manufacturing, and they're immediately accretive. DSI is expected to generate full-year 2025 revenues of between $1 and $1.1 billion.
$1 billion in revenue right out of the gate.
And adjusted EBITDA of 150 to 170 million. So it's a massive and immediate infusion of both capability and revenue into Quanta's underground and infrastructure segment.
But the real strategic insight here, it isn't just the revenue number, it's the synergy. It's how DSI's mechanical and plumbing expertise combines with Quanta's existing work.
Yes.
With the grid work and their previous acquisitions like Cupertino Electric, CEI, which gave them that inside electrical expertise, this is how they build that total solutions model.
This is the crux of the competitive moat. In these mission-critical facilities, a hyperscale data center, a semiconductor fab, the mechanical system, so HVAC and cooling, the plumbing, like process water and waste, and the electrical systems are collectively considered the critical path infrastructure.
The critical path.
Meaning if any one of those three disciplines fails or falls behind schedule, the entire multi-billion-dollar project stalls. So together, Quanta's combined capabilities, especially with DSI and CEI integrated, now allow them to address approximately 60% of the project scope inside data centers and other mission-critical facilities.
That is a revolutionary level of control for the customer. Why is having one provider control 60% of that critical path so much better than, say, coordinating 3 separate, highly skilled contractors?
It's all about de-risking the schedule and mitigating coordination errors. In the traditional model, the mechanical contractor blames the electrician for delays, who in turn blames the site prep team.
The blame game.
Right. And when you are building a facility that costs billions and needs to come online yesterday to support AI workloads, speed and certainty are everything. By controlling 60% of that critical path under one roof, Quanta just significantly reduces site coordination errors. They eliminate redundant efforts. And most importantly, they can guarantee labor availability and scheduling certainty across these interdependent systems.
So they're not just a contractor anymore.
They move firmly from being just a construction contractor to an indispensable solutions partner. They offer the client an execution certainty that they simply cannot find anywhere else.
And that execution certainty is apparently enhanced by DSI's technological advantage, specifically around prefabrication and modeling. For these highly specialized fields, like semiconductor manufacturing or advanced battery plants, you just cannot afford any errors.
You can't. And you're right. DSI uses Advanced Virtual Design and Construction, or VDC, and Building Information Modeling, BIM, integrated right across their workflow.
And this is more than just some nice-to-have software.
It's essential for coordination. BIM allows the mechanical, electrical, and plumbing systems to be modeled together in 3D before a single piece of pipe is ever cut. This preemptive coordination, it minimizes conflicts on site, which is absolutely crucial given the hyperdensity of systems inside a modern data center.
And the scale of their off-site manufacturing capacity that speaks to the speed the market is demanding?
Absolutely. The need for speed in data centers and reshoring, it just demands modularization. So DSI maintains approximately 530,000 square feet of fabrication space across 10 different facilities.
Just for off-site modularization.
Right. They build these large sections of mechanical or plumbing systems in a climate-controlled factory. It ensures quality, it maximizes efficiency, and then they ship these modules to the site for a fast, almost plug-and-play installation.
So they're building Legos, in a way.
Very, very complex Legos.
Yeah.
And this capability allows Quanta to accelerate delivery, which is exactly what these power-hungry, labor-constrained customers need.
And the market is rewarding this strategy.
Immediately. The new technology and load center segment, which is where DSI and CEI now live, is expected to achieve massive growth. It's estimated at 100 to 105% in 2025.
100% growth. Just incredible. Okay, so we have record financials, we have huge backlog visibility, and we have this strategically superior, vertically integrated platform that's tailored for the fastest growing infrastructure markets. That is an ironclad bullish story.
It is.
Now, let's pivot and confront the necessary risks. How is Quanta managing the inherent operational risks that come with executing these massive multi-year construction projects, especially given that high percentage of fixed-price contracts we talked about?
This brings us to their core business philosophy when it comes to execution. The primary risk mitigation tool they have is what they call the self-perform moat.
The self-perform moat.
Quanta typically self-performs over 80% of its work. This means they rely heavily on their own internal craft labor and expertise rather than relying on external subcontractors for the majority of the job.
So they're not just a general contractor managing other people's crews.
For the most part, no. By retaining control over labor, they gain control over project scheduling, over quality, and they can provide cost certainty to the customer. They don't have to chase subcontractor availability or worry about subcontractor margin.
We've heard the CEO emphasize this. He says the nucleus of the company is built around its craft-skilled labor. This workforce is their biggest asset.
It is.
But also, as we'll discuss in the verdict, probably their largest vulnerability. But focusing strictly on execution, how does this self-perform capability specifically help them manage that fixed-price risk? As we noted, 56% of revenue in 2024 came from fixed-price contracts.
That high percentage is the constant tension in the business model. Fixed-price contracts, they offer greater reward, but they also expose Quanta to much higher performance risk. If a project suffers unforeseen site conditions or regulatory delays or labor shortfalls, the margin on that fixed contract gets immediately eroded.
And the self-perform model helps how?
It allows them to react faster and pivot resources internally to solve problems. They aren't waiting for a third-party subcontractor to free up a crane or a crew of electricians. They control the resources.
And financially?
Financially, they mitigate the impact by diligently recognizing revenues from what are called change orders and claims, but only when they are deemed probable of collection. This requires constant, meticulous management of the customer relationship and the project scope to ensure every unexpected cost that falls outside that original contract is appropriately documented and billed.
This complexity, it must necessitate using smarter, more collaborative contracting strategies for the really big jobs to share and de-risk the exposure. We see that with their use of joint venture or JV structures.
Absolutely. For the massive, capital-intensive, and long-duration projects, especially those involving new technologies or high regulatory hurdles, the use of JVs is a core risk management strategy. A great example is the partnership with Zachary Group for that massive 3-gigawatt NiSource CCGT project.
And CCGT is combined cycle gas turbine.
Right. These projects are inherently complex, and they're prone to massive cost overruns. The JV structure helps de-risk both sides against potential cost escalations and schedule uncertainties by sharing that burden. And it's important to note the CEO has publicly stated that they are extremely selective about taking on CCGT risk. They are very disciplined.
And we also see this collaborative risk management reflected in their ongoing complex operational commitments, like the work they're doing in Puerto Rico with Olume Energy. The sources cite a pretty significant financial connection there.
That's a crucial point of focus for any investor analyzing their risk profile. The partnership with Olume Energy, which manages the entire transmission and distribution system in Puerto Rico, it's a long-term, very intricate JV structure. It involves political risk, operational risk, financial risk.
And Quanta has money on the line.
A lot of money. As of Q3 2025, Quanta recognized receivables of $193.4 million from its unconsolidated affiliates, which is primarily LUMA. So while JVs are designed to share risk, that $193 million receivable demonstrates that Quanta still has significant financial exposure to the ongoing political and regulatory environment in Puerto Rico.
So if the JV runs into deep regulatory or financial trouble.
That's a massive potential liability that requires constant, active, collaborative risk management. It's not a set-it-and-forget-it deal.
So their strategy isn't just about sharing the financial burden, it's also about sharing the expertise up front to prevent problems from ever starting. Their construction-led approach is part of that de-risking process, right? They leverage their construction know-how in the scoping and design phase.
Precisely. The traditional industry model, it often involves an engineer-led firm designing the project first, and then they tender that design out to a construction firm. This often leads to massive redesigns, conflicts, change orders.
Because the design wasn't actually practical to build.
Exactly. We call it the margin on a margin problem. Quanta strategically flips this. By leading with their construction expertise and front-end services like scoping and design, they facilitate on-time, on-budget delivery. They ensure the design is optimized for efficiency and constructability using their own self-performed capabilities from day one.
So it's a solutions-based approach.
It is. It de-risks the entire process for both Quanta and the customer. It fundamentally reduces the chances of those unforeseen problems that typically destroy fixed price margins.
Okay. We've established the massive financial tailwinds, the structurally superior total solutions platform, and the sophisticated ways they try to mitigate risk through contracts and self-performance. Now let's synthesize the entire investment case. Let's pit the clear strengths against the structural vulnerabilities to deliver the final verdict for the investor.
The bull case is, it's exceedingly strong. You have a $39.2 billion backlog. You have the newly integrated total solutions platform, which lets them control 60% of the critical path work in these high-growth load centers like data centers.
So they're perfectly positioned.
Perfectly positioned to capitalize on generational tailwinds, massive electrification, AI-driven data center demand, and long overdue grid modernization. The structural tailwinds suggest, potentially several decades of sustained high demand.
But wait, we just saw the numbers, and the stock is trading at above peer multiples. The market rarely misses a story this clear. Doesn't that mean the market has already fully priced in these generational tailwinds? Doesn't that leave us with minimal upside if their execution falters even a little? If they're trading at an implied high 60 times forward PE valuation, investors are paying a huge premium for future execution certainty.
That is the critical conflict for investors right now. Strong revenue growth and the integrated platform, they highlight Quanta as the undisputed leader. But the recent share price reflects a very high expectation.
Perfection is priced in.
In a way, yes. The market is assuming flawless execution on that massive backlog and sustained double-digit EPS growth. Any significant misstep or margin erosion, especially on those big fixed-price contracts, could lead to a sharp correction because the valuation is already so leveraged to the future.
Which makes the most acute structural risk labor scarcity absolutely paramount. Quanta's execution certainty hinges entirely on finding and training enough of this highly specialized craft labor.
Indeed. The largest constraint on their growth and the most acute structural risk they face is the supply of skilled labor. Quanta is fundamentally reliant on a large, highly specialized craft labor force. Linemen, inside wiremen, mechanical specialists, plumbers.
Especially after the DSI acquisition.
Especially now. These aren't general construction workers. These are specialized tradespeople performing complex, often dangerous work. The CEO himself notes the constant struggle to fill in the gaps and the necessity of continuously investing in new talent pipelines.
Can you elaborate on the scale of the solution they're attempting? What's the actual cost and effectiveness of their pre-apprentice programs, like Northwest Lineman College and the Lazy Q facility?
The NLC and Lazy Q facilities, they represent Quanta's direct investment in vertically integrated labor development. They are, in essence, creating their own feeder system for these highly specialized roles that the traditional education system or, frankly, the union structure can't supply quickly enough.
But there's a paradox here, isn't there?
There is. The paradox the CEO highlights is that while the world is moving faster with demand accelerating exponentially because of AI and electrification, patience and experience are still invaluable in craft labor training. You can't rush the required field hours and certifications for a 765 kV lineman or a critical path mechanical specialist.
So the required pace of training clashes directly with the urgent speed of market demand.
It's a direct conflict. And execution delays driven by labor constraints are therefore a real ongoing threat to margin realization on every single fixed-price contract. They are, in a way, chasing their tails, trying to scale the workforce fast enough to meet that $39 billion backlog.
And beyond the operational headache posed by labor, we still have macroeconomic and policy risks looming overhead. These could cut off those massive tailwinds, regardless of Quanta's operational efficiency.
Exactly. On the macro front, you have ongoing risks like high inflation, rising interest rates, and the threat of a recession. Any of those could severely impact customer capital expenditure programs.
How so?
Well, if financing becomes too expensive because of high interest rates, utilities might defer non-critical projects, and manufacturers might delay building massive new plants. And you still have volatility in commodity prices as a threat. Even with their MSA hedging, extreme spikes can still challenge project profitability.
Then there is the structural policy risk that often determines the long-term project pipeline, especially for clean energy and renewables.
We have to highlight the risk of policy uncertainty. The current environment is highly favorable. You have tax credits and government funding for electrification. However, if there are budgetary constraints or, potential shifts in political focus, there is a risk that clean energy tax credits or government funding for renewable projects could be reduced or eliminated.
And the timing on that is key.
Particularly post-2027. Such changes could potentially cause project delays or cancellations. That would impact the electric segment's long-term project pipeline, even if the underlying utility grid hardening work remains robust. Investors just have to factor in that a significant portion of this growth narrative relies on stable policy support.
So to bring this all together, the investment case for Quanta Services really boils down to disciplined, flawless execution against a truly generational opportunity. They've built the strategic platform, they have the cash flow, and they have the $39.2 billion roadmap.
Yes.
But they're being rewarded handsomely today for the promise of execution tomorrow.
I think that's fair. The final conclusion rests on management's ability to maintain the humility and operational discipline that the CEO advocates for. His stated worry, the human risk factor, is that arrogance will always get you.
So despite this massive growth, they have to stay humble.
They do. For the company to truly capitalize on that backlog and their integrated platform without falling victim to the inevitable pitfalls of rapid scaling like overcommitting resources, underestimating project complexity, or simply failing to solve that acute labor scarcity, they have to stay humble. They have to stay focused on the safety and execution certainty of their craft labor. That focus is the razor's edge. It's the difference between justifying this premium valuation and really disappointing the market.
Risk defined, portfolio protected.